this was seen as a deflationary shock. And I remember I'm thinking I was stupid, but how is that not inflationary? This is the recipe for stagflation.
Why is inflation so sticky? How long is it going to last? And where should we invest? These are the questions that I am going to explore this week with our guest, Vincent Delward of StoneX Financial. Welcome to Global Macro Update from Malden Economics. Vincent Delward from StoneX, it's great to be with you today. Really looking forward to this conversation. And one of the reasons is because you were talking about inflation before COVID. You were early to the inflation story. So I'm really curious. That was not consensus thinking. I'm curious what you were concerned about pre-COVID that made you lean towards your inflation call.
Well, I think we have to go back even before that and try to understand why we had 40 years of disinflation or outright deflation. And to me, it boils down to three main sources. One, you had a global savings glut, meaning that a group of countries, mostly the European Union, especially Germany, China, and commodity-producing countries started to accumulate enormous current account surpluses. And different reasons in every case, I'm not going to go into it, but you had basically these global excess savings that got recycled into the treasury market, created this kind of artificially low yield, and was like basically too many people wanted to save, not enough wanted to consume. That was disinflationary. The second one was Mexican immigration. From the late 90s to the late 2010s, we had about 10 million Mexican migrants coming into the U.S. These were people of working age who were very easily integrated in the U.S. economy, which at the time needed a lot of workers, and that kept downward pressure on wages. And then the third one is a demographic argument. And basically, my view of demography is that it's deflationary at first and inflationary second. Once you have a big generation like the boomers who are reaching their 40s, 50s, 60s, which was the case in 90s, 2000s, their consumption drops because they no longer have. They already bought the house, they already paid for the kids. So you reach that point where the empty nester, right? The goal of life. You no longer have to take care of anyone. You're making peak earnings, so you get to save a lot. And this is collectively what the West was into, especially in Europe, where we had a much bigger baby boom and a much bigger baby bust after that. So we had a lot of excess savings, not enough consumption. And of course, all these three things are reversing right now. And they were reversing before COVID, right? I mean, if you think about the global savings glut, well, it's clearing up. Clearly, Russia is not going to invest its surpluses into U.S. treasuries anymore. It's not clear that China wants to do it either. So that's one. Germany no longer has a current account surplus, in part because of the shock to the PPI. So that's gone. The immigration story is actually reversed. We now have more Mexicans leaving the U.S. than we have coming in, and partly because of demography and also partly because, I don't know, Americans are moving into Mexico right now. I mean, I was on road trip in Mexico City 2 weeks ago. I mean, La Roma is literally Los Angeles now. And I understand why. I mean, better food, better climate, better people, much more fun to move down there. But anyway, that's a source of labor that we no longer have, at least to the extent that we had it 20 years ago. And then on the demography, I mean, of course, it's boomers. The median boomer was born in the early 50s. So now he's turning 65. And they're going to start retiring and drawing from Social Security. Instead of being net contributor to the system, they're going to be net beneficiaries. Their production is going to fall to zero as they retire, but the consumption is not going to fall to zero. In some cases, it may even increase. So that's the kind of the second effect of aging on demography, on inflation. First is deflation.
Vincent, does that generation hold enough in equities so that when they start their forced spending down, that it will also have downward pressure on the markets?
I mean, I would argue probably a lot of Americans don't own enough for retirement. But if a generation does own, relatively speaking, the boomers are relatively much wealthier than the other cohorts. I mean, the savings problem is mostly something for the millennials, the Gen Z, who got hammered by the great financial crisis as they started building wealth, never really got back into the market. So the boomers, relatively speaking, are abnormally wealthy generation. Now we could argue that's probably not enough. One thing that will help the boomer though is that they're going to get Social Security. I'm not sure that the future generations are going to get it, but certainly the boomers, given their electoral weight, are going to get the Social Security, and Social Security is indexed on inflation. So you'll actually see the boomers get a historical pay raise when the actually COLA is announced. It should be around 9%, right? Cost of living adjustment. So they're not going to be, very rich in retirement, but they certainly be comfortable. I'm not sure we could say the same for the generations that will come after.
So how did COVID impact your thesis? Did it just accelerate everything, or was there a big twist?
Yeah, good point. No, as with many things, COVID is like an accelerator of history. The trends that had been going in the background slowly just happened in, for example, with tech, they say we had, 10 years of tech progress in one. And it's the same thing with the story. Like, I don't understand why the market thought this was deflation. The first reaction to COVID was we had, oil prices went negative. 10-year yield fell to 50 bips. Break-evens went negative in many countries. This was seen as a deflationary shock. And I remember thinking I was stupid, but I'm like, okay, what are we doing right now? We are destroying the global economy. We are breaking global supply chains. We are preventing people from working. And then we're sending them checks to stay at home. How is that not inflationary? I mean, you curb supply, you boost demand. This is the recipe for stagflation. So in April 2020, I had what I think was my best report to this day, a crazy but logical call for stagflation. At the time, I could not finish calls with clients. I was being called crazy. But then inflation did pick up. And first, the Fed kind of, it's okay, just reopening. Don't even talk about it. And then we had the transitory story. And then we had the blame game. So first it was lumber. Then it was used car. Then it was plane tickets. Then it was hotels and restaurants. Then it was a shift to services. Then it was a shift back to goods. Then it was a shift back into services. Then, of course, it was Russia. I mean, if you have to make, a different excuse every month, maybe there's something else going on.
Agreed. So and now we're in a situation where the Federal Reserve and other central banks are raising rates rapidly. And I had been arguing for months and receiving a lot of pushback, but I had been arguing that interest rate hikes aren't going to have a huge impact on the rate of inflation because it's both supply oriented and it's structural. There just aren't as many workers as there were before the pandemic. The composition of businesses is different than it was today. There aren't as many restaurants, for example. And you wrote, and this is why I was so excited to speak with you, someone, I think it was actually Louis Gav from GavCal, who sent me a piece of your work from August. If you don't mind, I want to just quote you. You wrote in your August 22nd letter, you were listing all the reasons for inflation. And one of them is inflation is driven by structural issues which hikes and recessions will not solve. Productivity has fallen after COVID. The labor market can remain very tight and inflation can keep rising amidst a recession, which happened in this past quarter, now 2 quarters ago, as unit labor costs rose 10.8%. Spot on.
And I think that's the missing piece in the market story. In general, I've been somewhat more bullish on the economy than consensus, but no, I do see the economy slow. I'm not questioning that. But I would not jump to the conclusion that an economic slowdown is going to solve the inflation problem, because there is a missing link here, and that's productivity, right? So we've been kind of accustomed to as soon as growth slows, unemployment increases, and that solves your price pressure. That's the world we used to live in, because we had steady, if not great, productivity. But if we switch to a world of negative productivity, which is where we were in Q2, we don't have the data for Q3, but Q2 we saw a 10% increase in new labor costs, which is kind of absurd, 5% higher wage, 5% lower productivity. If we had, which is my thesis, a shock to the U.S. workforce, and I believe is yours as well, that the U.S. labor force coming out of COVID is not the same that we had, because we have much more structural issues. Obesity is one of them. We have 40% of the population that's obese. And it's very hard to do. A lot of the jobs that we cannot fill are jobs where you need to stand up. Construction, restoration, hospitality, food preparation. We just literally kind of missing of physical bodies, and which is why my earlier point on Mexico was, I think, important, because we used to feel that with Mexican immigrants, which are no longer coming. So we have that. We have the mental health issue. We also have, if you look at the scores, I think the survey came out on we lost about 30 years of progress in math and basic math for the generation that was impacted by the COVID. Basically, the kids are taken back by 1 year because of the lockdowns and all that. And it's especially bad for kind of low-income communities. So we have a structurally less productive labor force. We also still have, some COVID restrictions. China has not completely reopened. We are talking about deglobalization. Supply chains are not fixed. So a lot of the forces that kind of helped productivity grow in the past 3 decades are no longer there. And keep in mind that if productivity is negative, we could have a situation, which is kind of my expectation, where we have a mild recession. Let's say GDP drops by 1%. But let's say productivity drops by 2%. That means that you need your labor force to increase by 1% to produce less. And if your labor force increases, you never really clear the tightness in the labor market. You keep this very tight labor market, and your Phillips curve kind of shifts. You need a higher level of inflation, structurally higher level of inflation, and that's my expectation for not only the next year but truly the next decade.
Can we talk about energy a little bit? Energy prices, at least gas prices, not everything, but gas prices have come down. They've eased in the U.S. at least. Do you see that continuing, and how closely tied do you feel energy and inflation will be moving forward?
Yeah, that's an excellent point. On a monthly basis, there's about 99% correlation between the CPI-U, the normal inflation, and the energy CPI. So really, if you wanted the immaculate disinflation, what the market was pricing this summer, the view that inflation would fall from 9% to maybe 4% by the end of the year, and then 2-3% by mid next year, which is kind of your most optimistic scenario, you really needed the corporation of global energy prices. You needed gas, oil prices, and it started like that. We got 120, going to 180. So, but it should have kept going. and what strikes me is that now we kind of have a hard floor on oil prices. I mean, that's coming from OPEC and from the SPR. I mean, OPEC told us no 80, no mass. That's it. If oil drops below 80, I'm going to cut my production. And we have a physically tight labor market. Yes, we have a physically tight labor market, but we also have a physically tight physical oil market, where we're about short 4 million barrels globally. So we're addressing that by doing SPR release every week. We also have much lower Chinese imports because their economy is still under lockdown. That's probably 2-3 million of demand that's not there. And then, of course, we have energy conservation in Europe. But these things can't last forever, right? With the SPR, we know that at some point we're going to need to refill it. The target at which that happens, I don't know. He mentioned $80. Now it's more like 75, but it's not close from. It's quite close from where we are. So it seems very unlikely to me that we will see, what we would need for the economy to really disinflate quickly, which is $50 oil. It's much more likely to me that it's much bigger risk that we see $100 oil back in the winter. Maybe because something bad happens in Russia. Maybe because China finishes a zero COVID policy. Maybe because a big pipeline blows up somewhere. I mean, there's a lot of scenarios that leads to 100 or 100 plus oil prices. Not that many that leads to $50.
And it looks to me like energy, particularly natural gas, is going to become much more global in nature. I was just in New Orleans, and I took a drive south of New Orleans, where there's a big concentration of oil and gas infrastructure. And the amount of construction that is happening, the amount of investment in that area going on right now was really striking to me. I stopped at a facility that's a new LNG, so liquefied natural gas terminal. $8.5 billion project. Easily the biggest construction project I've ever seen in my life, including recent New York skyscrapers. Just phenomenal. That, I would think, if we're going to start exporting, and all of that terminal is built for export of LNG to Europe. So what is that going to do to U.S. prices and European prices?
Right. So, I mean, it used to be that, oil is a global market, energy is, gas is a regional market, not gas, right? Because not gas is hard to transport. You need, pipeline, you need to liquefy it and then deliquefy it. Yeah, that's, if Europe is no longer going to import from Russia, that will have to change.
Right.
And I mean, that's the opportunity, I guess, for the U.S. For the U.S. energy sector. Obviously, for a long time we had much cheaper gas price in the U.S. because a lot of the gas was stranded, especially around the shale fields. Because as you extract shale oil, you get some nat gas, and that gas as a result. So we had all these issues in the grid. I think it's a multi-year opportunity for energy investment. Which we haven't done enough of, certainly not in conventional sectors. And then now we are, faced with horror at the consequences of our actions, and we need to catch up very rapidly. So, I mean, that is, that is kind of part of my, I guess we can talk about it later, but I have this view of the optimal portfolio for 2023 is energy, healthcare, financials. I think energy, conventional energy, really has a very important role in your portfolio. It's still not a big part of the index. I mean, energy is probably less than Apple in terms of the entire energy sector is worth less than Apple in terms of market cap. But it is the only sector that has a positive correlation to inflation. And if we think about the big risks of 2023, they are all energy related. So you don't really need a bullish view on oil and gas, as I believe you and I have. You almost need it from a risk management perspective. What is your big risk? Your big risk is that oil goes back to 100, inflation goes up, the Fed can never stop or even pivot, and then all risk assets sell off. In that scenario, energy is the only asset that will do well. And it's also a world now where we're facing where stocks and bonds are no longer offsetting each other. You cannot hedge an equity portfolio with a position in long-term treasuries. What does that, however, is commodities. Every time the market was down last year, well, at least not every time, but on average, when the market was down more than 1%, commodities were up. So you need having a substantial allocation of your portfolio to energy equities or commodities, smooths the ride, reduces your standard deviation, increases your Sharpe ratio, makes your portfolio more efficient, almost regardless of the expected return of the sector.
What's your view, Vincent, on interest rates moving forward and inflation moving forward? Do you see it, it seems like the consensus is that in the next year or so, we will get back to close to 2%, which I just can't see happening. Do you agree with that? And do you think rates drop?
So let me first address the inflation, because the inflation is going to be, what runs the rate. So yes, I agree with you. I think inflation has peaked, at least for now, unless we have this kind of dark horse scenario of $150 oil in the winter. But my baseline expectation, 9.1, was the high for this cycle, and we're going to disinflate. My guess is we end the year at 7.5 on the CPI, which is not enough to justify cuts after that. Now, after that, there will be, hopefully, if energy behaves, there will be a base effect help, right? Because Putin invades Ukraine in February. Every commodity price goes up by 50, 100%, right? So now we're dragging this base effect, and then that's going to invert in February, March. So we could go down, my guess is going to go down to like 5-ish. Now, the interesting part about that is that this is about when the Fed, the terminal rate for the cycle is priced to be around 5, right? So there will be kind of this golden moment where the two lines may cross. And at this time, I think Powell will have a unique opportunity to declare victory. And hope that everyone forgets about the mistakes he's done. Kind of like, remember when George Bush had the mission accomplished sign on the aircraft carrier, right? Okay, we won. Let's never talk about this again. That's my expectation. Now, my expectation is that after that, inflation doesn't slow. And that's where I disagree with the market. The market is pricing that, we're going to go back. If you look at a 1-in-1 inflation swap, we're down to like 2.5%. So the market is really believing that we're going to go back to, about 2% inflation, and then very rapidly. Now, I don't believe that. I think we go down to 4 or 5, and then we remain stuck there. And then who knows, it may even accelerate, kind of like it was in the 70s. If you remember in the 70s, after Yom Kippur War, 73, inflation goes to first oil shock goes to 10%. recession of 74, 75, we go down to 4. The Fed cuts to 4, thinking it's going to go down to 2, and then it just kind of stayed there and even picked up in the late 70s as we had the Iranian Revolution. That is my expectation. So when it comes to rates, for the first time in a very long time, I'm cool with the front. If you look at the front of the curve, this was ridiculous this summer, right? We had this completely improbable narrative that the Fed funds rate would peak at 3.5%, and then we get 3 rate cuts starting in March. That was a joke. But now we got almost 200 basis points of tightening in the front, right? That was a big story of the past 2 months, was that repricing the front end of the curve. And I think, you know what, it's probably about right. I don't see, 75, 50, 25. Like Powell is going to do what he promised with the market. I mean, there's not much value for him in kind of shocking the market again. There's plenty of, he's done that already. And I don't think an extra 25, at the end of the day, he's trying to make up for the hikes he didn't do a year ago. So a joke I like is, you want a baby right now, right? And instead of like you haven't impregnated a woman 9 months ago, but instead you impregnate 9 women right now. I mean, it's still going to take 9 months to bake, right? So that's what the Fed is kind of trying to do, like, throwing more hikes to make up for the hikes it didn't do. But it takes time. Monetary policy acts with a lag, I guess, is my point. And of course, Paul knows that. So anyway, jokes aside, we're fine with the front. The part where we're not fine at all is the long end. We're pricing a dovish pivot starting May, 1, if not 2 cuts. And I don't think inflation will be low enough to justify that. And then you got to start thinking, if you and I are right about, secular inflation, 5-ish% for the next decade, the 10-year is not priced right. You're looking at 4% today on the 10-year. That needs to go at least to 5, maybe 6. Wow. So I think that's going to be the story. The story of 2022 was pricing 500 basis points of hike in the front. I think the story of 2023 will be to price 200 or 300 basis points of steepening at the long end.
Vincent, let's end this with your ideas about where investors should be positioned. We already talked about energy, and you mentioned, I believe, healthcare and financials as the other 2 sectors you heavily favor.
Yeah, so that's been my whole, I call that the Holy Trinity portfolio, which for the year is up 5%. I mean, in the year when, pretty much everything is down, the 60-40 portfolio is on more than 20. And this is a 100% equity portfolio. So let me repeat the Trinity: energy, healthcare, financials. You have very liquid ETFs that you can, very cheap, that you can trade to implement that view.
Okay.
Why these 3 sectors? Well, you have to ask yourself, what are the big risks? And it's 3. And every correction we had this year was about either of these things. Either it was about inflation. Oh, inflation is too high. And in that case, your hedge is energy. When you see inflation surprises, every sector is down, energy is up, right? Energy is the national inflation play. So you're protected against inflation. Another source of worry for the market this year has been recessions. And the most defensive sector is actually not utilities. If you look at the Pharma French data, the best performing sector during recession is healthcare. And I would argue especially now, because this recession is going to be about higher rates, right? So utility is not a good hedge, right? Why would you buy, 4% dividend yield on utilities when you can get that in T-bills? On the other hand, healthcare is not really exposed to rising rates, has a lot of pricing power. Historically, the healthcare sector CPI exceeds the inflation in the economy by about 2%. Very good balance sheet, very defensive profile. So healthcare performs best if we do have a recession indeed. And then the third risk that we've been dealing with all year long has been rising rates. And there's one sector that benefits from rising rates, is financials, right? And you saw that in the earnings of JP Morgan, of Bank of America. It's not that hard, right? I mean, you get people's deposits, you pay 0, and then you get the IOER, which is going to be 5%. I mean, you really have to be a moron not to make money like that. The other thing that financials do well is if the yield curve steepens, which is my expectation next year, they make more money, right? Banks generally borrow short and long. So if you have a steeper yield curve, your net interest margin goes up. And the beauty about this portfolio is that not only it's up for the year, not only it has relatively low volatility, because at any given point, you always have the best performing sector, because you always have, the hedge against the free main risk, but you buy it for super cheap. You buy your energy earnings for 6 times about. You buy your bank's earnings for like 8, 9. And then your healthcare earnings a bit more expensive, but it's like 12, 13. And these guys are growth like big tech. You know, you see growth in big tech slowing, while healthcare profits actually growing faster than tech earnings. But yet the valuation is very different, right? You pay 30 times earning for Microsoft or Google, and you see them miss earnings. Why not go with the big pharma, which is just minting money from secular demand because the U.S. population is sick and it's aging.
With banks, do you have any concern about loss of reserves as people seek out short-term yields that they can get? It's the first time in almost a decade or more where you can actually earn some interest on your money, not in a savings account, but like you said, at the front end of the curve.
Yeah, that's a good point. We do have very elevated cash balances in deposit. That some of that money could go into money market funds. But again, I mean, banks offer products there, so will people really take out the money from the bank and then buy a treasury direct? I don't think that's what a lot of people do. I mean, there will be other sources. Pardon me?
It's not easy, I can tell you that. Treasury direct does not make it easy.
No, it's a shame, but I mean, I bought T-bills last month. Why am I overthinking? Like so much risk in the equity market. I can get 4% on a 12-month T-bill. I mean, it's just right. And I'm not talking about the tips like the I series, where the coupon is much higher because it resets with inflation. Right. I mean, you have this very high short-term real yield for the first time in I don't know, since I started working. Really, like we can get like 2% real yield, inflation adjusted. Mm-hmm. But I mean, this is probably something that we do, but I don't think the general population does. Another thing that will help the banks is you see your credit card balances are rising, but it's still to the point where people can pay it. So it's the perfect point, when you can slam this really high, credit card balance rate on people and they can still pay it. And I don't think we this is why I think I'm a bit different from confidence. I'm bearish on the real estate market, but I don't think people are going to walk away from their homes. I don't think we're going to see foreclosures. I don't think we're going to see a lot of loan losses the way we had in 2008. I don't think we'll see a banking crisis. But yet the banks trade like we'd have one. I mean, if you look at the multiple on like a Citigroup, I mean, it's almost like a distressed stock. So I think that is the opportunity for next year. I would say in the short term, the sector I'm most excited about is probably banks. Medium term is probably energy, and then long term is healthcare.
Vincent, we're going to have a link where viewers and listeners can get some samples of your work. We'll put that in the YouTube description and in our weekly email. We'll also give a link where they can follow you on Twitter, which they absolutely should be doing. Vincent Dewaard from StoneX, I really, really enjoyed this conversation. Thank you for taking some time.
Me too. Thank you very much. Hope to do it again soon.
Thanks for watching. If you'd like to get an emailed copy of Global Macro Update sent to your inbox every week, which includes a summary, a link to the video, as well as a transcript of every discussion, just click on the link below in this description. It's a free service. Just enter your email address. We won't spam you, and we'll send Global Macro Update to you every week. Take a minute to subscribe to the channel. Thanks for watching. I'm Ed D'Agostino. Catch you next week.